This is everything you need to know about financing your next real estate deal. Hey, how's it going, everybody? It's Justin Artist checking in again, and today I want to talk about how you can get lending on your real estate deals. So there are really four major types of lending options when you're looking to purchase your next real estate deal. Those four are conforming loans, where you're working with a mortgage loan officer. You have seller financing, where you're working directly with the seller. You have asset-based lending, where you're working with someone that holds private money and lends you money based on the asset that you're buying. And then you also have portfolio loans, or what I like to call small bank loans, where you're working with small local banks. So for conforming loans, a loan officer is going to mostly look at you to determine how risky of a person you are to lend to. So they're going to look at things like your credit score, they're going to look at your W-2 and your income and your bank statements and your tax returns to see how much money you make and what is your debt to income ratio. So loan officers are verifying all this information about you because they have to meet a bunch of guidelines that are governed by Fannie Mae and Freddie Mac. And these are very large government-backed corporations that essentially buy all the loans from the loan officers. So a loan officer doesn't hold on to your loan for the full 30 years of the mortgage. Typically, they will help you get the loan and they'll fund it, and then 3 or 4 months down the line, they'll sell it to Fannie Mae and Freddie Mac, and then they get their original capital back. They make money from the few months of interest that they make on it over that period of time, and then also all the closing costs that you end up paying whenever you go to purchase a home. So since Fannie Mae and Freddie Mac are going to hold the loan for the life of the loan, they put out the guidelines of what they want you to meet in terms of a buyer, and then all the loan officers verify that you meet all those requirements. Typically for investment deals, lenders are going to want to see you put down 20% of the purchase price, but there has been some new guidelines that came out in the recent past that allow you to put down 5% on 2, 3, and 4 home multifamily properties. But just keep in mind, if you're less than that 20%, you are going to have to pay the PMI, which is the private mortgage insurance, which is going to cut into your cash flow. So a couple other requirements that conforming loans have are that the house must appraise for at least the loan amount or more. Otherwise, the bank's not going to lend you money more than what the house is worth. Additionally, the house has to be mostly livable. So it can't be all dilapidated with walls torn down and no electric and water being able to run through it because the plumbing isn't hooked up. It has to be a mostly livable structure. So there are other loan products like the FHA and VA loans, but those are mostly for your primary residence. So you can rent those later on down the line, but you have to buy those homes with the intent of moving into them. So whenever you close, I think you have like 60 days that you have to move in. Lastly, for conforming loans, they're going to want to see you close in your own name and not an LLC. So if you're looking to do this for asset protection, that's going to be kind of hard. A lot of people say you can close in your name and then transfer the house to an LLC, which you can do, but you run the risk on violating the due on sale clause, which is baked into basically every mortgage that's written out there. And that basically says if you sell this property, which you're doing whenever you transfer to another LLC, technically, they can call the note due. So that is a risk that you could run into, so just make sure you understand that. So the second type of loans are asset-based lending, or hard money loans, as some people like to call them. So this is essentially private groups that have a lot of money that they lend out to investors specifically, and they are shorter loans, usually like 12 months, and they're interest only. Typical structure for a hard money loan is 12 months with a balloon payment at the end, and it's interest only. So that's typically 10 to 11%. So let's say if you have a $100,000 loan, you're going to end up paying $10,000 over the course of a year. So 10,000 divided by 12 is what your monthly payment will be. And then at the end of those 12 months, you're going to have to pay back that full $100,000. So the good thing about hard money loans is that the lender is looking at the asset itself and not you as the buyer. Hard money loans also allow you to buy homes that need a lot of work and that are run down that you would not normally be able to get financing with on a conforming loan. And that's really the only time you would want to use a hard money loan anyway, so you can get that home that you wouldn't normally be able to get lending on and fix it up, increase the value, and then refinance into a conforming loan that's 30-year fixed rate mortgage for your asset over the long run. So typically, the asset-based lending will only lend up to 70% of the ARV, which is the after repair value. So if you can get the purchase price low enough and the rehab budget on top of that to be 70% of the ARV, then you can get the loan, and then whenever you fix it up and you refinance out later, you'll have enough money at the end to then pay the full hard money loan back. So the last good thing about hard money loans is that the lenders do this all the time, so they're gonna run the numbers independently of you and also assess if it's a good deal, so you get that extra layer of backup to help you know that you're buying a good deal. Seller financing is a third option on how you can get lending for a home, but these are definitely more few and far between that I've noticed in my time investing in real estate, because it requires a person that has a lot of equity and basically has their home paid off. because again, they can't really sell you the home and finance it to you themselves because they have the due on sale clause in their mortgage. So it's typically someone that has their home paid off. And then it's also someone that is okay with not getting that lump sum of money now. They'd rather have that money coming in over the years or whatever terms you come up with on these seller financing. So you can go anywhere, from 3 all the way out to 10, 15, 30 years if you want it on the seller financing. It really just depends on what the seller wants. So this is good because you can negotiate whatever down payment you want, whatever the seller feels comfortable with, and also it cuts out a lot of the closing costs that the buyer and seller have in a normal transaction when you're going through a closing company, so both parties can net more money. Lastly, you have small bank lending. The difference between small banks and like mortgage officers, for example, is that a lot of times the banks will keep these loans on their books, so they'll hold them for the life of the loan. So then if they do that, then they can meet whatever guidelines they want. They don't have to conform to the Fannie Mae and the Freddie Mac guidelines. A normal loan structure that you might see with a small bank is a 5-year ARM with a 30-year amortization, which essentially means that they take the interest rate and they still spread it out over the 30 years, but you just make those payments, principal and interest, for 5 years, and then at the end of those 5 years you have to pay back the remaining balance on the loan. So you can either do that by just paying it outright, or you can refinance into some other type of loan product. Small banks do lending like this because it makes it less risky for them to actually hold the note for 30 years, and then they can reassess after the 5 years to see if they want to continue lending on that, and also if you want to continue lending with them. And then also they get all the extra money from the additional closing costs when you have to refinance that property. So for them it makes sense, so that they don't have to wait 30 years before they get all their money back, that they can reinvest it. Another benefit of small banks is that they will allow you to close in LLCs, especially as you start to build relationships over time. So that about wraps up what I wanted to talk about today. So if you're a real estate investor, you really need to understand the different ways that you can get funding on your real estate deals, and in which situation, which loan product is the best for you. Typically what people do is they'll use asset-based lending or hard money loans to go buy rundown properties that you might not be able to get conforming loans on anyway, or you can get that same type of lending with seller financing on that type of property. But then once you fix the house up and it's worth a lot more and it conforms and it's livable and it'll appraise for the right amount, you can then go refinance that into a conforming loan once you have a tenant in it that's going to cash flow, and then that's going to be a 30-year fixed rate mortgage that you won't have to worry about changing or refinancing for a very long time. Hey, thanks for watching the video. Please comment, like, and subscribe. It really does help out the channel.